I graded this deal a solid B, and I'm still wiring $100,000 of my personal capital on the same terms as our investors get. Let me tell you why. This came to me from a fund that I have been tracking for the better part of a year. Well, in August, it oversubscribed and it closed its doors to new investors. They're completely done taking in new money for this fund. But we secured the last part of their allocation. And this is what this video is going to be about. So, quick housekeeping item. This offer is for accredited investors only. Everything you're going to see here is a target. It's not a guarantee. Investments carry risk. The offering documents govern all of this. Okay. So let's jump on in here. But first, I want to give a little context. My name is Morgan Keim. I run a company called Ocean Ridge Capital Partners out of Southern California. And for more than a decade, I've been on both sides of north of 100 real estate deals, some of which I've run myself as the general partner. Others, I've been the passive check writer or an active allocator that has actually pulled capital together to invest in deals. And that's how I know what a solid B looks like in today's market. So our model is pretty simple. I will diligence hundreds of opportunities, select one that I like, and take a large position with a top tier operator, and then open that up for our investors to co-invest with me so that a $50,000 or $100,000 accredited investor can get terms that might normally take upwards of $5 million to unlock. We back fewer than 1% of what we review. And by the way, this deal itself, it might be right for you, it might not. My goal is to help you determine whether this kind of thing would be a good fit for you, the kind of thing that would help you create cash flow and durable income outside of your company, outside of your career, outside of your roles, like I have done for myself. So let me dig in a little bit. What we are buying is super boring, and I love that. Really three classes of assets that I'm concentrating in at this point in the real estate cycle. One is self-storage. These are storage units that people rent units in for a move or because of a divorce or a kid comes home from college, and they have them 3, 4, 5 years later. They're very sticky tenants, and it's recurring income where a lot of the profit passes right through. The second is small bay industrial. This is probably the thing that people think about least in real estate, but it's actually a really essential asset in the economy. And we're talking about, the HVAC guy with 4 trucks and every tool he owns. Where does he put that? It's not usually at his house, right? This is the plumber and all of their tools and equipment. These are the bays for contractors that every town relies on. I mean, their businesses frankly live there. And lastly, an asset class that Ocean Ridge has a lot of experience with, which is mobile home parks. This is, the family that owns the home, but not the dirt underneath it, the last vestige of affordable housing. And most towns have not permitted new parks in decades. You simply cannot build competition for these. And it really becomes about how can you improve what already exists. So super boring, but there's nuance in each of these to actually add a lot of value. Let's talk about the Patriot Fund itself, because this fund has 18 of exactly these assets across 11 states. And here's the level set. Most deals that you see in your newsfeed or in your inbox, they're asking you to fund a projection. Well, in this case, the work has in large part already happened. The buildings have been bought, they're operating, and this fund has been sending distributions to investors before any of us ever even wired a dollar. So everything on this page is net of every fee. But this is kind of what we're looking at in terms of some of the headline projections on this opportunity. Okay, now the part that really got my attention outside of this just having a pretty good IRR target and everything is the price itself that we're paying to buy into the fund. We are buying at the exact unit price that investors paid 2 years ago when they were backing a blind pool before they bought any asset, before they worked on any asset. That sounds like too good to be true, and you very rarely see this kind of thing. So there has to be a catch, right? Well, there's actually two. Mainly it's that one, this is the shorter hold period that impacts the equity multiple, which is how much you'll make on your money. And two, the cash flow is kind of lumpy. And we're going to get into that in just a minute, both of those scenarios. But I want to just really draw attention to what this is, because look what happened in the last 2 years in this portfolio. Storage and industrial occupancy is up from 70% to 85% in a year. Net income is up 38% since the start of the year, which directly is proportionate to the value of assets. And appraisals even have come in north of 17% above what the fund paid on average. So we are not paying for the improvement, we are inheriting it. It's a benefit of our access point. Now, why does this even exist? I'm very good friends with one of the partners who has anchored this fund. He's an experienced allocator and he has had money behind this. We were actually able to pool together with him and cross the fund's $5 million institutional threshold before they closed the allocation in August. So instead of getting a retail share class, we actually hold an institutional share class, which gives a better profit flow versus if you went direct to the fund. And that is locked in, it's in writing, it's in our side letter. And that's why this allocation is locked and it's finite. We only have $2 million that we can go in. So I'm bringing it to our existing investors as well as have a couple seats left where some new investors can co-invest with us. So that's why you're seeing this video. Now let's talk about Patriot Holdings. This is the operator of the fund. 17 years in business. They run across these 3 asset classes and everything's under their roof, by the way. It's under one roof. They are vertically integrated, have one of the top storage brands in New England, goes by APS, all-purpose storage, and they close about 3% of the deals that they see. Off-market acquisitions, buying directly from mom and pops before they ever even can shop their properties. And so that's a major part of their model. And they've had 0 unplanned capital calls. They've had one of their funds go full cycle for 19 to 24% realized IRRs. The rest of their funds are currently operating and have not fully exited. So the record's real, but it's thin. And I'd rather, be very transparent about all of what I see in this opportunity so that you know the good, the bad, the ugly behind it and can make the right choice of whether this would be a good one for you. Okay, so this is what $100,000 invested into Ocean Ridge's SPV would look like. So this goes into Patriot Fund's allocation. So let's make it concrete. The base case net of all fees at both levels is 17% IRR target. So there's also an 8% per year preferred return that accrues from the day you fund. And the honest timeline, it's right here on the table, but I don't think 2026 will pay us anything on our allocation. The first cash will be likely around mid-27. And the bulk of our compensation comes on the back end of this fund's hold period. They're trying to wind it down by the end of 2029. We conservatively underwrote that it might take a little bit longer than that, but the bulk of our compensation is going to be 2028, 29 as they're starting to wind down the fund. So my point here is if you need quarterly income this quarter, or if you need money, your money next year, this is probably not the right deal for you. But if you like the idea of building income over time, a relatively short hold period, and having a lot of the risk already out of a deal with a pretty reasonable equity multiple, this might be a good deal for you. There are 2 other cases to consider. What I was showing is the base case. Mainly these oscillate between having lower or higher operating results and selling into a weaker or stronger market. The conservative case, obviously the execution slips a little bit and the market's a little softer, and it's still a 12.2% projected IRR. That's again, net of all fees. The upside is if their plan fully lands after fees. So, and by the way, you don't have to take my word for how we operate and invest. Transparency is incredibly important to me. We have a number of investor reviews on Invest Clearly, all 5 stars. The line I want to highlight here, Morgan leads with what could go wrong, not just what could go right. So let's do that. Let's kind of break down what some of those key things are that maybe aren't so great about this deal, because everything, a lot of this sounds pretty good, right? So, in terms of the 2 weaknesses I had flagged earlier, one is, like I said, this is roughly a 3.5 year hold. So the total equity multiple, the multiple of what you'll get on your cash, is lower than what it might be if it was like a 5 or 7 year hold, right? And so that's just something to know. This is a quicker deal with a lower equity multiple. The other thing that I want to flag is there's an existing preferred return queue that gets paid down first. So remember I said the preferred return accrues if it hasn't been fully paid. They're running a little bit of a balance. And so I'm projecting that those distributions will be paid first in Q4 and Q1. We'll start getting cash flow light, but starting into Q2 of next year, so 2027 year, and then it really builds from there as we're part of this fund. So I think it's honestly a fair trade when I look at all of that for having 2 years of de-risked price point at the same price as what people had to pay. You may see it differently, and it's exactly why we should have a call and maybe talk this out. Real quick, the fees, because I'd rather you see what this is than wonder, there are 2 layers of fees. So the sponsor has their fees, that is inside their fund. That is the institutional allocation that we secured, like every fund has, right? Second to that, Ocean Ridge has a layer on top that is for the SPV of our capital that we've pulled together that invests as a single check into Patriot. So every number in this video is already net of both. The full stack is on the slide. It's also on the deal page, and you can read about it in the OM. So here's the next step. And by the way, it's not wiring money. It's a 15 or 20 minute call. If you were accredited, and what I mean by that is you've made at least 200K the last 2 years, expect to do it this year. If you're single, 300K. If you're married or have $1 million net worth, not including the value of your primary residence, and you have 50, 100, 250K that needs a better job than what it's doing for you, book a call in the link below and bring your hardest questions. Really stress me out. It's okay. I have nothing to hide on these, and I want to show information asymmetry on the private markets. That's my whole mandate for bringing these opportunities. So I'll bring the model. I have a scorecard. We can go through anything, including everything that I don't love about this deal. And if it's a fit, you can reserve your allocation on TribeVest. It takes a few minutes. The vehicle is capped. Like I said, we are the last $2 million going into this, and we're going to be raising it basically through the end of September. And this is the last allocation into this. You know, in terms of our last deal, just be aware, we actually closed our last deal out in 48 hours. We had to return about $200,000 of commitments. So some of these can go a lot faster than others. I cannot guarantee that this stays available. So if you do want to explore this, book a call, don't hesitate, no pitch. We'll have like 15-minute chat, 20-minute chat to see if it would be right, and we'll go from there. Again, this is a 506C offering for verified accredited investors only. Targets are not guarantees. Hope to talk to you soon. Thank you.